the interest, I don't know if Ken Mobley is on tonight, but we got a request to add his son to our roundtable list. Remember his son who was walking on to the Temple University football team as a kicker?
Yeah, I do remember very well.
Well, he actually got himself a spot on that team, and he's still interested in investing 2 years later. So he asked to be added to the roundtable reminder list. So he's now on our list. And Nick,
Excellent.
we just hit 100, Nick, on our attendance. So
yeah, I see that.
That's really nice for the day before Thanksgiving. I appreciate
Absolutely.
that. Yeah. Or the 2 days before Thanksgiving. So
I think I agree with you. Everybody's turkey's defrosting at this point, and maybe they have a pie in the oven, and they have a couple of minutes to sit and listen.
Well, back in the day, I scheduled a program on the day before Easter in Chicago, and I very quickly was relieved of those responsibilities by the chapter.
okay, Mark, somehow the recording started. So it's been recording, and we're ready to take it away whenever you are, Mark. It's 8:30. Okay.
Okay, give me just a second here to put my leg in a sling. Classic too much tennis, which you've already heard in the past, Ken. So, all right, are we ready to go then?
Yes, we are.
All right, let's go ahead and take it away. Welcome everybody to the Thanksgiving November 2019 edition of the Roundtable, and our reminder to be thankful. I'm thankful that I still have a right leg, even if it hurts. But it is a good time to be thankful, as the audience will see here in a few minutes. We have a large amount of gratitude for the good fortune we've been bestowed upon with many of the selections of the Roundtable and the long-term performance. But again, we are here for the purpose of sharing ideas. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the sponsors of this event. I'm joined by some of the friends that I'm most thankful for on this planet. Starting from left to right on the cover slide, that would be Nick Stratigos from Pittsburgh in his, I believe that's the Shrek guys from one of his plays. Is that correct, Mr. Stratigos?
That's absolutely correct. I played Shrek's dad in Shrek the Musical about 5 years ago.
And the added feather there is just, to keep it consistent with the Thanksgiving theme.
Mm-hmm.
That and the chiseled rock abs, which I'm sure is pictorially accurate also.
Absolutely.
Okay. And second from the left is Kim Butcher, our dear friend from Evansville, Indiana, and she spends a fair amount of time in the sunny vistas of Florida. Kim, I think you're online with us right now. Is that correct?
I am here.
All right. And then my good friend to the slight north of where we call home, Ken Kavula. He's I'm not sure how he ended up with the wizard hat, but I'm sure he's a Harry Potter fan. Good evening,
Good
Ken.
evening, everybody. Good evening.
There's a pretty good feast in front of us there. Now, Hugh McManus, again, is fairly typical. He was really hoping to join us, if for no other reason than to be really, really, really thankful for our delecs.
Amen, amen, amen.
Amen is absolutely correct.
So Hugh is he's threatening to need another wheelbarrow for the award show that we do every February for the Roundtable, because our Delex is kind of setting things on fire right now, and we're thankful for that. What we're not thankful for is that Hugh is traveling again on business tonight and is unable to join us. So let's go ahead and get underway. I think I can do that. Slide advance, please. And we've got the boilerplate. No investment recommendation is intended. Please do your own homework. If you're here for the first time, again, we do this for demonstration and illustration of the philosophy and methods of the Modern Investment Club movement. If you or someone you know would like to be added to the reminder list, you can see the second email address from the bottom there, nkavula1@comcast.net. And then if you have any follow-up questions, we will leave time for a Q&A at the end. But if you have any follow-up questions or you'd like copies of the slides, just simply drop me a note at markr at manifestinvesting.com. Here's our standing agenda. We pretty much go through this the same thing every week. Again, every month when we do these. Welcome, especially those of you that may be joining us for the first time. But again, a big shout out, big Thanksgiving hug to the 100+ attendees that are here. Many of you are returning for multiple months. We will talk about our results. We do keep track of how well we do. We do not have many challenges. We'll talk about challenges, potential selling considerations, selling studies within the portfolio, but we really don't have much to talk about there tonight. And then we'll do the thing that we like the most, and that is the sharing of ideas. So Nick's going to bring Five Below. I'm going to present ITRN Location Services, ITRN, Ken Kavula. I'm really glad to see you doing this one, Ken, because it kind of got swept under the rug a month ago. And we might talk about what happened there, but Cantel Medical is CMD. Kim Butcher is in one of my favorite theme areas right now, medical telemetry with biotelemetry and BEAT. We'll hold a poll at the end. Again, if you're joining us for one of the first times, you are welcome to vote. And then we do try to leave some time for Q&A at the end. So let's go ahead and step lively. Just a reminder, this is why we're here. We do this once a month. We've been doing it for almost 10 years now. We're just trying to share an idea and show how we look at it through the prism or the spyglass of the modern investment club movement. How do we think about these companies? What's important to characterize any potential investment before you own it and after you own it, for that matter. We do strive to beat the Wilshire 5000 by 5 percentage points. We'll talk about that. And we would like to beat the market over half the time. We would love to see 60 or 70%, but we would like to beat it more than half the time.
Mark, can I break in for just a moment, please? We have two people that have asked us, can they get these slides somewhere else and listen to the whole recording? They're at work and they're going to have to leave us fairly soon. The answer is yes. The whole presentation gets posted on YouTube. It might take 3 or 4 days. This is volunteer help, folks, but it will go up on YouTube. And the channel you're looking for is either Manifest Investing Roundtable or Better Investing Roundtable. Same channel. You'll see not only the most current recording, but you'll see recordings that go back more than 8 years. We don't have some of the really early ones up, but we have almost all the recordings from more than the last 8 years up there for you to take a look at. That's also the same place where you find recordings of the new program that Mark and I are doing called Ken and Mark Investing Tips. So I just wanted to get that out there for those two of you that have to leave to go to work. We're awfully sorry you have to leave us, but you can view it on YouTube.
Yep, and just to reinforce what Ken said, youtube.com, do a search for Manifest Investing Roundtable. If you put that in the search box, you will find it. If you have trouble with that, send me an email and I will send you a link. Those of you that are Manifest Investing subscribers, you should know that the link to every one of the last 12 roundtables is available every week in that This Week at Manifest box. So as you go down that summary, you can actually access all of the old ones. All the ticker symbols are there. And as you guys all know, we have a little bit of extra fun in the roundtable extended stuff that we do in our discussion forum. All right, so back to how we've done. And again, this is, I should have a picture of, the cornucopia on this slide. The maybe a dancing turkey is in order. That would be a good thing, a dancing turkey. What you're looking at here is the performance, again, approaching 10 years. And what we do, we have a rate of return. We keep track. We invest $1,000 into every decision that is made, every selection that is made, and we keep track over time. The rate of return on that since inception is 17.4. Mirroring or matching investments in the Wilshire 5000 over that same time frame would have returned 11.8. So you subtract one from the other to get a relative return. Some people call it an excess return, but it's basically the answer to the question, how much am I beating the market by? And the answer here happens to be 5.6%. That dotted line that you see across the middle of the graph, that is the traditional investment club target of beating the market by 5% with your investing endeavors. And you can see that about half the time the selections made have actually beaten the market over that time frame. But again, I think we give this a standing cyber applause. It's a lot of fun to be up in this neighborhood. We hope to stay there, and we'd like to even drift a little bit higher over time. Any thoughts or comments from any of you guys?
No, except it's a pretty graph, and I never thought that we'd be able to do what we're doing. There's a lot of doubt out there in our own community sometimes about whether clubs can actually do what we're demonstrating right here. I'll tell you, there's not a whole lot of formal investing education attached to the people that pick the stocks for the roundtable. And yet, if you pay careful attention to what Better Investing talks about and what Manifest Investing talks about, I think you have a reasonable chance of beating the market by 5 points. We're getting a couple people asking if there's sound problems, and no, there are no sound problems that we're aware of right now. If you're having sound problems, I would suggest that you might be on Wi-Fi, and if you're in the house with somebody that is streaming, that many times will cause sound problems on GoToMeeting. That's the only thing that I can tell you if you're having sound problems yourself.
Yeah, and one of the things we have seen in the past when there are some fairly robust storms, I'm not sure what actually happens in the physical world, but there's some pretty heavy storms out west right now, and sometimes that, for whatever reason, and even solar storms can cause disruptions. All right, let's go ahead and talk about some of the companies that have actually built that performance. What you're looking at here is what we at Manifest Investing refer to as a dashboard. Some of the key characteristics for any company are shown here. What you are looking at is the top 20 holdings in the model portfolio. As I said a few minutes ago, every time we make a decision or a selection, we invest $1,000 into that company, and that could be whether it's from a knight, a damsel, or the audience. So that $1,000 gets invested in, and as you can see up here at the top, this legend gives you a clue as to how many times a particular position has been selected. So in the case of Cognizant Technology, it's actually been selected 15 times over 10 years. That $15,000 invested in it is actually worth just short of $23,000, as you can see here down the middle of the chart. So you can see there are a few that have only been selected a few times. One of our favorite stories involves Hugh McManus. A two-time selection of Amazon, that's $2,000 invested, is now worth $12,000. And we love it when that happens. And there's a few on here. Global Payments, I believe that's a one-timer. Is that correct, Ken?
I think it is, yeah. I'm looking at Universal Display, the third largest holding mark, and that's only a 4-time choice, and 3 of the choices were made on the same night. When I presented it, you presented it, and the audience chose it. There was also a single presentation that I made earlier, but 4 choices, that's pretty nice return for 4 choices. There's Ardelyx up there, really moving up the chart near the top, and a number of these don't have a whole lot of choices behind them, and yet they're making the top 20 or top 22 list right here. This is a great place to look for ideas. Nobody's saying these are all buys at the moment, but it's a great place to look for ideas going forward.
Yeah, Global Payments was a one-time choice because that's when it was TSS, and we picked that right after the 08-09 when it was down at I think $20.
Yeah, those are always fun. One thing I thought I would do is take a moment to talk a little bit about Ardelyx, since Hugh's not here and we won't spend any time later in the program. This is a 5 or 6 time selection, I believe. Well, actually 7 now. So he began selecting that a couple of years ago at a price of between $10 and $11 a share, and it's gone down as low as 2, and we selected it several times down around that 2 level. So those are obviously working out pretty well. And you may notice this is a company that's got a little bit different characteristics. It doesn't have earnings or earning stability. It's got a low quality rating. So this is one of those special situations or core holdings. For those of you that have not heard of the company, the ticker is ARDX, and this is an emerging early stage biotech company that's working on some fascinating solutions in the cardiorenal challenge area, and irritable bowel syndrome is another area that they're working in, and they're just having some real nice success. And Kim, you sent me a note, which I'll put in the forum, but can you summarize the news release that came out on them yesterday? Did you get a chance to look at that?
Basically, they have a partnership with a company out of Japan, and they've signed another contract with Ardelyx, and they're going to be giving them $20 million for 2 different drugs that are in their pipeline for helping them do further testing and be successful with it, because that's about all I saw on it. But that really affected the stock price, because I think it went from about $6 to like $6.75 with that announcement. So that was a nice, huge, over 10% pop.
Yeah, and that the price on the screen actually reflects tonight's close, which is $7.54. So that's good. And Hugh actually projected that if they were successful with some of their phase 3 pipeline testing, that somebody was probably going to come along and assume a co-development role. So far, we'll keep our fingers crossed, and we all know that this is sheer speculation, but it's kind of fun to watch an emerging situation like that develop. Any other comments on the tracking portfolio, guys? Let's go ahead and keep pressing on. There really aren't any true challenges. We define a challenge as a company within the portfolio that either has weaker fundamentals, but more precisely, this particular table is sorted from the lowest projected annual return, that's the PAR, on the far right-hand side. So these would be the companies with the lowest return forecasts. But we would also point out that the average company right now is hanging in there right around 8% or so. Let's just call it roughly 8%. So these companies, even the lowest ones in the portfolio right now, which bodes well for the future for the tracking portfolio, but these are actually approaching that 8% level, and I don't see any particular weakness in any of these. Any thoughts or comments on these guys?
I'd call at least 2 of those core holdings, Mark. I would place Dollar General and ResMed in my core holding portfolio. I happen to own both of those. I actually own 4 out of the 5 stocks on this bottom of the list right here, but I don't see any reason to jettison any of these, especially when our PAR is sitting, we've been kind of working to move that PAR up. We'd love for it to be in the sweet spot. It's at 12% right now. What was my PAR's close today? Do you remember, Mark?
Oh, just a little above 8.
Okay, so we have 3.5–4% on PAR, and that's certainly a nice number. What I'm focusing on is that we've worked really hard to move our sales growth number in this portfolio more towards the 12–12.25 range, and it looks like it's almost at 12 right now, 11.9. I am looking at the growth numbers on these 5 at the bottom, and 3 of them do have fairly slow growth, but they're not a large enough part of the portfolio to really change very much, even if we were to sell them. So I'm not going to recommend anything. I just think we keep watching them, and if these numbers begin to move down into the 0, 1s, and 2s range, then maybe that changes our decision.
And Ken, just for the people who are relatively new to this whole concept, you mentioned Dollar General being a core holding. How does that impact your selling decision?
Well, for a core holding, I'm looking to hold a core holding until its par value goes beneath what I can get for cash. And right now, for a money market, I don't know, what can you get a money market for? 1.25%, 1.5%, something along those lines. Is that the right neighborhood? So
yep.
Until those 2 cores move down to that place, and I'm not suggesting the others aren't core holdings. I'm suggesting I don't know enough about those other 3 stocks. 2 of them I own in club accounts, and 1 of them I don't own. So they might be classified as core as well. I know an awful lot of folks up around this area because my chapter includes Midland, Michigan, and that's the home base of the original Dow Chemical. So a lot of folks include Dow in their portfolios, and they include it as a core holding. I'm kind of thinking that we put Dow into the portfolio as much for its yield as for anything else. Was that right, Kim? I know that you were the one that chose Dow originally to go into the portfolio.
Well, I chose it because it was a spinoff, and when I presented it, I really felt it was undervalued at like $40. And the market, as they say, is a voting machine, and the market has finally agreed with. I think the price even has a bit more it could go up, but I also recognize there is a movie coming out called Black Waters about DuPont when they had a leak within the water supply that may affect the chemical company Dow just because it's a chemical company. But I added it because it was a spinoff and I felt it was undervalued, and that's why I brought it to the forum.
Yep. Dow has had a lot of problem with water up here in Michigan as well. So it's, they might get tarred with the same brush when it's all said and done. But I don't see any reason to move any of them out of the portfolio right now, Mark.
Okay. Yeah, in the overall portfolio, you can see the averages are there. Everything's in pretty much in order. We'd like to see a little more par. The only way you get that is by just adding companies that have higher return forecasts to the portfolio. So that's our mission for tonight. And so with that, let's go ahead and go to our friend in Pittsburgh. Now, Five Below, I'm pretty sure was the medalist this when we celebrated last February. So, Nick, are you going back to the well for this one?
I'm going back to the well because the market has been a little bit unfavorable to them and the price has come down. And so now they're back in the sweet spot and they're continuing to do what they want to do. So go ahead and let's go and have some fun. So what exactly does Five Below do? For those of you that don't know, they are positioned so that they can sell things at below $5. And they focus on what they call 8 awesome worlds where they sell wow products. And those cover sports, tech, creativity, partying, candy, rooms, style, and now. So go to the next slide, Mark. They focus these in some of the really neat areas, including the most recent craze trends. And you can see there from their products, they have things like selfie sticks and the fidget spinners and other current really popular items for those folks that are in the preteen and teen category. They have a lot of licensing that they do with Disney, particularly in the Frozen area, with Frozen 2 coming out, is certainly going to place them in a great spot because everybody's going to be wanting to get Frozen 2 stuff. They work with Legos, and as Mark said before, and as I know from my own personal experience having a son, Legos are something that are very popular with younger folks. They're not so popular with parents when you're sleeping and walking around in the dark and with no shoes on. They tend to be rather painful, but they also have license agreements with Star Wars, and there's another Star Wars movie coming out here at Christmas time. So they have a lot of nice licensing with some really key name products. And they also try to focus on what's in trend now. They have the drone helicopter that they have in place. They have backpacks. They're looking at for the girls in the crowd. They're looking for beauty products like nail polish and those sorts of things, and they also focus on what's going on now. Right now, they happen to show on their website some of the summer things. As we sit here and hear about tens and 20s of inches of snow, we all wish we were somewhere where we could use the sunshine and the pool toys, but they do focus on those kind of things too. So go ahead, Mark. Here's their target customer, and they really have 2 targets. One is that Gen Z group, the 8 to 14-year-olds, and I probably would expand that to really, upper grade school all the way through high school. Those are the kids that have a little bit of allowance, and they can go to the store and they can buy things for their room. They can get some technology things, support for their phones, support for their computers, whatever the case may be. And they're also focusing on those kids and their parents. So these are the Gen Xers, the 24 to 44-year-olds. So the parents are using the Five Below 2 to be able to help out their kids and really be able to do things for them without having to spend lots and lots of money. Go ahead. They have, when we look at a company, we want to find out what their growth drivers are, and they really have 5 distinctive growth drivers to their company. They focus on that tween and teen age group. So they really do try to get products that are going to meet their needs. They handpick trend right wow products. And again, that's that wow products. They have people that they specialize in discovering these wow products and getting them on the shelves. They have exceptional value for $5 and below, and as we're going to hear in a little bit, they're also starting to expand that 5 to be a little bit more, moving a little towards $5.55 and $10. We'll hear about that in a minute. They want to make it a fun and differentiated shopping experience, and this is another area where they are focused. They're looking at making a lot of renovations and innovations in their stores. Those renovations are really making the stores more enjoyable, easier to get around in. They're also focusing on innovations in their front end so that the folks can get in and out of the store pretty quickly. And they're also focusing again too on this idea that maybe 10 might be the next number they go to, especially in the tech area. And then they have disciplined high growth, and I'm going to underscore the high there because management has a significant consistent track record of driving high growth. So go ahead, Mark. Right now, this is their geography. They just entered their 36th state this year in Arizona. You can see over time, they've grown from about 200 stores to where they're going to be at about 900 by the end of this year. As of the end of August, they were at 833. They started out in Philadelphia, and so most of that green area was their original set of stores. They've moved into 36 states now. They target about 20% growth every year in their storefronts. So that's that. They still have lots of states they're not in yet. A lot of the Pacific Northwest, a lot of the mountain areas. So they still have a lot of places to go in terms of the geography. And within some of the newer states, they still have lots of opportunities too. So go ahead. They tend to locate their stores in high traffic centers. I know mine here locally in Cranberry Township where I live happens to be in a plaza right next to Best Buy, right next to a Dick's Field and Stream store, and right next to Walmart and Costco. So they are in high traffic areas. And when you look at their traffic that comes in, about half of it comes in where Five Below is their first stop, 45%. And about 55% is a second or third stop. Once they've stopped somewhere else, they come to Five Below next. But they've also got success across all the different diverse markets. They have urban outlets like in Philly and DC. They have suburban outlets like the one where I live and some of the other places you can see there. And they also have semi-rural places where they have stores. So they are really spreading themselves into the right places to get the traffic that they need. Go ahead. So here's the graph. We always look for up, straight, and parallel, and I think we'd all agree that this is up, straight, and parallel. Although you'll notice a little bit as we moved into 2019, the pre-tax profit and the earnings have slowed down a little bit, and I'll talk about that in a second. But you can see the most recent quarter, the July quarter, they had sales growth of 20%, which is their target. Their earnings were a little bit slower at about 13. Go ahead, Mark. Here's where their strategic growth priorities come in. They want to continue to grow that store base. So they're going to continue to grow it across their geographies. They're continuing to reinvest in those WOW merchandise. They want to increase their brand awareness, and I'm not sure if you've noticed, but I certainly have, that they have a lot more commercials on the TV now to help with the brand awareness. I realize that we're coming into the holiday season, and this is going to be a great place for their target market, those tweens and teens, to go and do their Christmas shopping. They're working to scale their systems and infrastructure, particularly as they go through some of the renovation process and setting up their new front ends. And they continue to build their team and their culture around the WOW experience. As it says there, no one else does what we can do in 8,500 square feet. And you can see from the pictures here too, they've not only set up their store in a nice, convenient way, in a nice, pretty looking way. They also have fun and dynamic stores. They have strong crews. They're called WOW crews for the staff that work there. But they're also starting to incorporate some of the social media type things. If you look at the bottom left, it's a hashtag 5B style. That is right out of all the social media. So when you come into the store, you may have already seen that and you're looking for a specific product. You can be able to see it because it's up high on the store. You can see the same thing over in the workout area where it's hashtag 5B gains. They also have, and I kind of thought this was neat, and probably moms and dads want to keep them away from there, but there's one called Sugar Rush, and that's where they have all the candy and everything like that. So go ahead. Their vision is for 20% growth. Their management team focuses on 20% sales growth every year. They drive that through strong net income, and that net income allows them to do it without going into any kind of debt. And that's an important piece, is that they have no debt at this point. They also have a strong management team in place that delivers on annual comps. And what comps are in the retail space is that this is comparable sales for stores that have been open for a year or more. They strive to target 3%, and you can see, even going back before they were public, they went public in 2012, you can see before they went public, they've always been over that 3%, with the exception of 2016, where they were only at 2%. But they continually deliver comp sales above the 3%. So they're really looking at a 20% growth from the stores and the 3% on the comps. So there's a potential there for maybe a 23% growth. Go ahead. I wanted to share this, and this was kind of interesting. As Mark said, I presented this a couple of years ago, and I just wanted to show you the notes that I had in place a couple of years ago versus now. That was the year where they had the low comp store sales, and now they're at 3.9. That year they were looking about for 100 stores. This year they're looking at 150. And in fact, they've grown so far from the beginning of the year to August, when they last reported, from 750 to 833. I talked about the innovations. They are in the process of remodeling, and this is one of the reasons why that pre-tax profit and the earnings per share have been impacted a bit. The other reason too, and I'll share that now, is that they've also had some impact from the tariffs that are in place. The next innovation they're working on is they're reimagining their front end. As I said, they want to make it simpler and make it quicker for people to get out. And they're also starting to look at a concept called 10 below. Because of the challenges of just being at $5, they're looking to expand some of their product offerings and maybe move to a 10 below concept. They're already in test market. They've done a test market with $5.55, and it's been quite successful in about 4 or 5 of the stores. And they're looking at a 10 below now too. They've actually started in the technology wow sector, if you will, where they're looking at $10 and below for the technology issues. They've also started, and this happened after I presented last time, they've also started an e-commerce plan. So they actually have, believe it or not, a lot of the 5 below stores, the comp sales come from the experience, but they're also starting an e-commerce plan where you can actually go online and buy things and have them delivered at home. When I look at my different sources for potential growth, Yahoo growth looks like it's about the same. Maybe they've cut it back maybe 1%, but it's still about 20. NASDAQ I liked a lot. They've changed their page. I can't find it so much, so I've put Zacks in there, but they're still pretty strong at 24% expectations. Value Line has them a little under 20 at about 17.5 on sales and 19 on earnings. And Morningstar has them also very strong at 23. And as I said, there's their targets for their stores outstanding. They're looking to get to 900 by the end of this year, which would represent 20% growth. And they're looking to put another 180 stores in place in 2020, which would also represent 20 growth. And I also was excited to see that they've gone on their long-term target from 2,000 stores to 2,500 stores. And that happened within the last year. Go ahead, Mark. When I looked at the growth, I looked at the projections. You can see that they've delivered at 23. That nice straight line is about 23.5%. I'm going to target them at that 20%. And again, I think they can actually grow at 23 since they've delivered strong on both the growth of the stores at 20% and the comp sales at greater than 3%. I think they can deliver 23 or greater. Conservatively, I'm saying 20. When I put it into the preferred procedure, which is there at the bottom, and use my 20% and use the current expenses and taxes and everything, then I come down to about a 20.9% growth rate at the bottom there for the earnings per share. That's going to drive the earnings per share to about $7.25. The pre-tax profit margin has been about 29%. In the evaluating management area too, you can see that their trends have been up. And while the last couple of years, the pre-tax profit on sales has kind of flattened out, to about 12.4, 12.3. I went ahead and used 12.5, and you can expect that that's going to stay flat probably in that range as they go through this renovation cycle. Return on equity is huge. It's certainly this, with this kind of a return on equity, they do have the cash in place to be able to grow at 20%. It's a strong number. It's pretty consistent over time. And as I said before, they have no debt. They have had no debt in place since 2013. So that allows them to be returning everything to the shareholders. Go ahead, Mark. When I put everything in place, it's got a pretty high PE. It's a very small company, not to $2 billion in sales yet, so it's at the lower end of the mid caps, if you will, the middle-sized companies. I expect with that kind of a PE and a $7.25, the price could get to about $2.90. Go ahead, Mark. We have there's a summation here. The SSG results in a buy right now. It's 3.2 to 1, and with today's close, the price actually went down a little bit more to about 123.25 right now. So the total return on my SSG tonight is about 18.6. So that number has moved up, and the projected return there, where you would use the average P, is at about 13.8. So I think it has an 18.2% return. Go ahead, Mark. I'm going to show the quality now. Five Below has been a strong, solid company with good quality for a very long time. And while it has had a little bit of a dip from about 99 or 100 down to 94, I'm not so concerned. And again, I'm sure the impact there has to do with the pre-tax profit drop and the earnings drop that have happened because of the focus on renovating the stores and having to deal with tariffs. So again, it still has a very high quality rating. It has a very high par. Next slide, Mark, to show those in summary. You can see the Five Below with today's close, that 17.8 has actually moved up to 18.3 on Manifest. So now we're over 18% there on the projected annual return from Manifest. So again, a very high quality company, 94, a very high par, about 18. I think this is a strong company. And if you'll move on to the next slide, I want to say let's go and have some fun and add another portion of Five Below to this portfolio.
Sounds good. Thanks, Nick. Yeah, I can definitely vouch, even as a person that's not in their target market, when we go in shopping for our grandsons, there's a plethora of things to choose from.
Right.
And it's a fun place.
And I'm actually surprised that they don't think of the grandma and grandpa age group too as part of their target market. I would imagine that would be just as important to them as the moms and dads.
Well, let's drive over to Philadelphia and talk to these guys.
Absolutely.
We can swing by Punxsutawney.
Mark, could you go, Mark, I don't break in very often on somebody else's presentation, but could you go back to slide 18, Mark?
18.
Yes,
sir.
I want to alert our audience to something that's going to happen in the next quarter or 2 quarters, depending on when the fiscal year for a company ends. The new accounting regulations that the companies have to use to report to the SEC are going to force them to put capitalized leases on their balance sheets as debt. And so when you suddenly see a company like Five Below in the 2019 fiscal year move from 0 debt in 2018 to about 40% debt in 2019, you have to be aware of why that is happening. We're going to do a ticker talk in the Thursday, a week from Thanksgiving. We're having the auditor from Better Investing on, Cliff Trent, and Cliff is going to explain the impact of this new item as far as the debt line is concerned on our SSGs. So you need to make jot that down and maybe come to that session and listen to how some of these numbers are going to drastically change. The company's not going to change, but the way that you're looking at debt is suddenly going to have numbers that on first glance are going to be unbelievable.
And that's important too with Five Below because they lease all of their space. they have 10-year leases in place, and most of those leases have renewal periods attached to them too. So they will be impacted by that accounting change.
Yeah, and the only reason that I bring this up, Nick, is that I know Cliff is going to speak about Five Below and Ulta Beauty specifically, those two companies.
And it makes sense too, because Ulta's the same with their storefronts. They tend to lease space too. They don't own anything.
Right.
So, one last comment too I'll make is that they are going to have a release of their third quarter earnings comes out on December 4th, which is a week from tomorrow. So we will be able to see where they're at in terms of that continued growth. Are they able to maintain that 20+ growth rate, and also get an update on the number of stores that they have in place?
Okay. All right, back to Kim. Did you want to wait till later? I didn't know what your schedule looked like during the session, or are you okay to go now?
The 5-year-old I'm watching is sound asleep, so.
Okay, why don't you go ahead and take it away then?
Okay, I'm going to present biotelemetry. The letters are BEAT, which closed today at $46 and change. One of the Ken always talks about in small caps what is disruptive technology. Well, right now, one of those disruptive technologies is wearables in healthcare. And this company has grown in the last about 10 years, and they now, within the last, I think, 2 or 3 years, they changed their name to biotelemetry. I have a tendency, every time I fly, I ask the person sitting next to me, is it business or pleasure? And if it's business, I'm asking him about the stock. That's how I found out about the stock. This guy who was sitting next to me was a regional manager. So there's another way you can always do some research. Next slide. They have 4 divisions. They believe that they can get best-in-class technology through in connecting with health by using technology to leverage it. And 83% or 85% of the revenue is with the heart. Now, I'm sure if any of you seen any TV programs, I've seen it a couple times on the news where somebody got a brand new Apple Watch, and it has that feature that it can pick up your heart rate, and it's registered that they have atrial fib, which is where your heart is beating so quickly, you're more prone to strokes. So they do have a study going on with Apple right now of how the Apple Watch can, it's not to diagnose anything, but just to help with your health practices of number of steps and everything else. It could pick up an irregular heartbeat. 13% of the revenue is by doing drug trials, and those are usually quite well, and they're trying to diversify from just being in the heart area and research to the care of the patient, like remote monitoring of blood glucoses for the diabetic population and health management. Because I know that when I was in the when I was working at the hospital, we had health management that if you had elevated blood pressure, diabetes, high cholesterol, they had health management services that they wanted you to go through so that you would get each of these areas down. So they're looking for a huge amount of growth that this can be for this company. The other area they have is the marketing the medical devices with medical companies to clinics and hospitals. So they're diversifying from just away from the heart area. And that is their specialty right now, but they've got into the research and other populations for health management. Next slide. This is what their highlights are of their objectives and results. They want to go wider and deeper with the cardiac monitoring, so that's why they're doing the research with Apple and the wearables that they do, because they're finding out when you wear a terminology of something called a Holter monitor, you wear it for 24 hours, and they have the chest leads on your chest for 24 hours, and it sees if it picks up any irregular heartbeats. Well, they're finding out that the longer you wear these wearable devices, the more information you get, but also doctors are able to see it so that if you then if they have to change your medication, patients are more compliant. And being more compliant, they get the better results. So in nursing and in medicine, it's called evidence-based practice. The evidence shows that wearing these wearables to register the heart rate for monitoring is giving better results for better outcomes, which reduces healthcare costs. So this strategic focus on working with what they're doing, on average, they've had a 10.3% year-over-year revenue. They've had 28 consecutive quarters of year-over-year revenue growth. They've acquired. This is a company that grows by acquisition. In growing by acquisition, you want to watch their debt and watch their cash flow. And they've done it consistently of being able to manage that well. And they have the same management team in place that they have had. So this is one of those companies that you always, it's a small cap. It's only like 400 million. So you watch what they're doing and can they keep that consistent? And they have been doing that quite well. Next slide. Here's the BioTel area, which is of the heart. They believe this still has a $2.5 billion area for market opportunity because, well, probably about 90% of us on this GoToMeeting right now are over our 50s, and we are in aging populations where our bodies are getting a little older and not working as well. So the more they can get the word out and market that and make people aware of it, they'll be able to diagnose things better. And they have to get the physicians' offices to even be aware of this. And they've just bought another company. They just bought another company in April, and this is going to they're going to have lots more growth. So they're going to be doing quite well, and everything should be going quite well with it. Next slide. This is where they talk about they have the remote cardiac monitoring. The Holter monitor is only with 2.5 million. The extended monitor, the yield and information they get is 60% more, and it's for $300. But the fastest yield and the fastest turnaround time when they do the monitoring for up to 30 days, you may have a higher cost. Hold on 1 minute, guys. I got to take care of this.
While Kim's actually taking care of that, I will just jump in to point out that this is one of our 20 best small companies for 2020 in the list that Ken and I put together around Halloween. So it's an area that we have paid some attention to, and it's one of my favorite investing themes out there right now.
Okay, sorry about that. Next slide. In them having this mobile cardiac outpatient telemetry, which are these wearables, it registers sympathetic when people have symptoms or asymptomatic events. And it gives you the fastest diagnostic yield, fastest turnaround time, and as I said, the best patient compliance. And so right now they're looking to get Medicaid to give them approvals for reimbursement as they develop more and more of these features. And as they get more compliance, which will be in, I think it's April or May next year, a year after the Geneva acquisition, they'll be able to have even more and more future growth because they're already getting the evidence-based practice in the research studies showing that they're getting better returns. Next slide. And as you can see here, it's showing you what the cost is. It turns out that monitoring this way is the lowest daily cost and the highest yield, which reduces healthcare costs. And that's the whole thing that we're always wanting. Next slide. Another thing showing where they've got the best clinical validation that these wearables are giving them better outcomes. And the whole thing in healthcare is we want the best outcomes we can, and we want it by the evidence that shows it, and that's what they're getting. So next slide. This Geneva acquisition that they did in March this year is going to get more information from the doctor's office to be able to send that out for pacemakers, any of the wearables that they have, to manage it with anything that has been implantable that can send anything out. It creates that value of over $1 billion, and it's the most profitable connected health platform that they have. And they have, like, it's with Abbott, they've got Medtronic, they've got lots of other companies that this Geneva works with. So it's going to be very profitable for them, I believe. Next slide. The research division is only 13%. So they are more research with the cardiovascular and imaging testing. So this is another area they're diversifying into. And they're winning because they're listed and known as the pioneer in the top quality service. So, and they're able to test all these new drugs on patients and using the wearables to find out which's getting the best outcomes. Next slide. This is from their last quarter. They've got volume growth, which is over 17%, revenue performance, which is over 26%, and their margin has been increasing, like 28% return with 40% CAGR. So there you go. I don't think anyone can complain with that. Next slide. Okay, now this, Mark, if you can circle for me, I want everyone to notice what the price of the stock is, highs and lows. If you look at this, like at least let's say the last 5 years, right? When this is after November the 15th, the recent price was $43, and it's a little bit above that now. But look what the price has been for the last 5 years. Notice that the low price to the high price is almost a double every time. 2015, we had $8 and a high at 17 approximately. Then we had $8.75 to 24. Then 21 to almost 40, 28 to almost 75, 37 to 80. This stock usually every year has a low that goes to a double of a high. And notice that solid dot that is at the very end of the graph there. That solid dot that's at the very end of the value line, and you have that solid black line there. That's what the price bars have been, where the value line is expected to do, and you've got a price right now that is underneath that solid black line, which means it's undervalued. If you look at cash flow per share, you can see how it's been growing. That's where they've had lots of acquisitions. So it went down in 2017 with a previous acquisition they had to 39 cents, and it's back up already. Their capital spending per share, they're always investing within the company. Their book value has been increasing. And look at that PE. They want it to keep on going. And the current PE is in the 40s. It's a small cap. It's going to be like that. But look what they think it's going to be out going far to the future. 21.8 to 20.9. That is a heck of an awful lot of growth, with probably a growth in the stock price. Their operating margins are getting nice and fat when they haven't done an acquisition. Next slide. If you look at here, they have capital leases. You won't have to worry about that there. They have, with the 4 different areas, and they're diversifying. I just think right now with the stock price on how it had been at 80 this year, and it dropped down to, I think, 37.80, which was its low, and it's finally just started to bump up. It's got me very interested, and we'll be watching it, because one of the things they had in the last quarter, they actually had, with these wearable devices, you have Wi-Fi they found that they had malware in with the Wi-Fi. It did not give any patient information out, and they were able to shut it down immediately, but they're not quite sure what's going to impact revenue, but they have insurance that's going to cover it. These are all things to be aware of. If you want to print out the transcript from Seeking Alpha, you can see this all in there. But this company for me is very interesting due to the fact that historically it's always had a double every year. So if you know what your low is, you know what your high is. That's interesting. Next slide. I got this today from E-Trade. This is what the 1 year target estimate will be, which would be a 74% upside. Something to consider. Next slide. And here is the manifest, and there you go. I hope you will consider this stock. Thank you.
Right, and as we were saying, it is among our top 20. I believe it's, as of right now, it's one of the top performers in the 20, and we've only been at it for a few days since Halloween, but we are hopeful also. Did you want to say anything about the point and figure chart, Kim, or you want to save that for next time? She may have signed off. Kim? Ken, can you hear me?
I can hear you, Mark. Yes, yeah.
Okay, let's go ahead and keep going then. Ken, why don't you go ahead and take us away with another healthcare stock, Cantel Medical.
Okay, Cantel Medical is a stock that's owned by one of my stock clubs. We had a long discussion on it last Tuesday because on first glance, some things didn't look right with the company. I'm going to try to explain what's going on and try to make a case for this company. Next slide. Cantel's a global company. You can see that it has offices and a presence throughout the world. There's a high presence in the Americas, and most of its business is still done in North America, although there's significant business in the European Union as well. Next slide. Cantel split into three different divisions: the medical division, the life sciences division, and the dental division. The medical division is by far the largest, with about $4.5 billion of the total of $7 billion market that the company addresses right now. They have a lot of endoscopic products, and when you deal with a medical company, you have these acronyms all over the place. So I've made an effort to interpret some of these acronyms so that you know what we're talking about from this slide that comes right from the company presentation. IP&C is infection prevention and cleanliness, and that's the overarching function that the company serves. They aim to prevent infection and then keep various things as clean as they possibly can be so that infection can't get a hold. HAI down in the medical section right there, maybe Mark can put a mark on it so you can see where it is. That's hospital acquired infections. In other words, you go in with one problem and then you acquire an infection at the hospital, which basically has nothing to do with what your particular disease or problem was in the first place. It's one of the top 10 leading causes of death. 75,000 deaths approximately in 2011. That number has been going up. That's a fairly old number, but this is one of the areas that Cantel is addressing, this idea of hospital-acquired infection. Their life science division talks about keeping various liquids as clean as they possibly can, and a lot of that has to do with patients that are using dialysis, ESRD, that's end-stage renal disease. Many of these patients are going to need dialysis, and the cleaner that you can keep the liquids that are involved with the dialysis, the less chance you have of the patient developing other problems besides the end-stage renal disease. The third category is the dental category. You're all probably aware when you go to a dentist, they use a lot of liquid, and there's a growing concern that that liquid has to be kept as clean as you possibly can make it to avoid other types of infection and to avoid the spread of infections. Notice that dentists are actually growing worldwide at a fairly decent number, 2 to 3% annually. And all three of these divisions have pretty robust sales in many, many, many different kinds of tools and monitors and measures. Next slide, Mark. I like the middle block on the top row right here. Government industry focus on infection prevention is a growth driver. And because there's such a focus on this infection prevention, not only in dentist's office, but in doctor's offices, in hospitals, in surgical centers, this focus will tend to shield the market from a weak economic cycle. So the conclusion that I draw from this middle block is that this company might not have some of the problems that you might get with some of the other medical companies if we move into a recession of some sort. The growth has been pretty decent over the last 5 years, about 9%. It's a pure play in the infection prevention market, and they are very, very acquisitive. Since 2000, they've made 37 different acquisitions, and all of the acquisitions are relatively small and fit directly into one of the three areas that the company operates in. Next slide, please. Really strong financial performance. You see that over half of their net sales come from the medical division, and almost 3/4 of their net profit comes from the medical division. You can compare the different margins and see that some of the margins aren't nearly as high as as some of the other margins, and therefore you end up with two pie charts that look a little bit different. Next slide. I'm looking at a company with consistently high quality, and here was the kicker for me at this time. The kicker was that really high par graph. That's the red graph, which is graphing par. And notice that at the end of October, that value was as high as it's been for the last 5 years. That's, to me, a historic high value. It's the kind of opportunity that I look for when I'm looking for a high quality stock. So when I see a graph like this, it's very, very interesting to me. So the next graph I go to, obviously, is the visual analysis. Next slide, Mark. I'll be there in just a second. They have a 3-prong growth drivers. They want to expand globally. I showed you the map. There's a lot of the map they can expand into. They want to continue to acquire, and they have a really solid record of putting their acquisitions into the company and making them productive. And then they want to continue researching and developing new products. They do have a significant organic growth driver as well. They actually break that organic growth out in their reports, their annual reports, and those numbers have been in the 5, 6, 7% range. That's pretty decent organic growth on top of the growth coming from acquisition. Next slide. This is telling you some of the things that they are doing to expand their sales and marketing. The biggest thing is they're moving into new market segments. And again, they're circling around this idea of hospital-acquired infections. They're doing everything they can to develop products which will help hospitals cope with this very real problem. Next slide. Their acquisitions have been in all of the different categories that they operate into. Their most recent acquisition is a company called Hugh Freedy. It's a 100-year-plus company that offered products to the dentist, to the dental community, and that's their most recent acquisition. They're already predicting that it's going to be accretive to the balance sheet in the first couple of months that they own it. You can read as well as I can that they're not afraid to make acquisitions within the US, but they also make a lot of international acquisitions, again, trying to increase their footprint throughout the world and trying to grow all three of their categories. Next slide. Here's the names of some of their products. These are products that they've developed themselves. Their research and development is very, very active in moving into products that this company that Cantel can develop on its own, and they've been very successful in developing and then selling products that they have the complete patent on. They have the complete set up with their sales teams on, and it seems to be driving their business. Next slide, Mark. Here's that visual analysis I talked about, and that visual analysis looked pretty darn good through 2018, and then suddenly you see earnings and pre-tax profit hook down. You see sales slowing just a touch. The company is very open and honest in presenting you with GAAP earnings and then presenting you with non-GAAP earnings. As you might expect, a company that does as much acquisition as this company has a lot of adjustments that it makes in the non-GAAP earnings area. And if you want to take the time, and it took a good hour and a half, 2 hours to wade through the adjustments that are going on and to ask myself questions like, do I agree with the adjustment that's being made or don't I? But I did finally adjust the earnings line. And if you go to the next slide, you'll see what that adjusted earnings line looks like. Now, I did not take the time to adjust the pre-tax profit line, so I removed it from the graph, but you'll notice that when you start to do the adjustments based on the reporting that the company gives you in their 10K and 10Q, you'll notice that earnings go back to following sales. There was a little bit of a slowdown, but it's not a dramatic slowdown as it appeared when you look at just the GAAP earnings that are reported. Next slide. I chose sales growth at about 9% to mirror the growth that has been going on for a large number of years. More than the last 8 years, the sales growth has trended at 9%, so I decided that was a good choice going forward. I chose EPS growth at 15%, which again is pretty close to what's been happening for a long period of time. I chose high PEs at 35 and a low PE at 25, average PE of around 30, and a current price during the day today of about $75. It gives me a buy with a par value on my SSG of 14.2. I compare that to manifest par of 15.6. I think those numbers are extremely close to each other, so I have some confidence in my SSG. I'm confident that I can explain the hook down in the earnings for Cantel. And prior to this company has been extremely consistent with what's going on. So I feel that I'm willing to take a chance with Cantel going forward. It looks to me to have some good things going for it that might keep it away from the cyclicality that I feel is going to move into the economy in the next 18 months or so. So I'm suggesting we add a position in Cantel Medical to the roundtable portfolio.
Oh, just some search results there. I'll double down on those in a minute.
Okay.
All right. Well, just one other thing I want to reinforce about the Cantel story is something we discovered with the data at Manifest Investing. Ken and I will probably cover this in our session on December 3rd or December 6th, whenever that is, when we do investing topics. And that has to do with the data that comes in. We're always looking for the current year, n equals 0, and n+1 and n+2 to look at the 2020 and the 2021 projections. And Cantel's year, I believe, ends in July. Is that correct, Ken?
Yes.
You know, and so that actually flipped over.
Well, okay, it's either June or July, Mark, but you're right.
Yes,
it's not a traditional year. Okay.
So what happened within our data, and something that we obviously now have to watch for, is we're constantly updating those projections. And so we had the wrong slots filled in for a month or so, and that kind of threw Cy off the trail a month ago, if you go back and listen to the roundtable from a month ago. But it has been fixed, and is something we are diligently watching for now. All right, let me go ahead and take it away real quickly here. I'm not going to spend quite as much time. I just wanted to share some fairly quick screening results. One of the things that we have been looking at doing is going through and accepting one of the Y charts criteria, and I'll expand on this next month, but we basically want to stick to companies that are in the top 10% of financial health or financial strength according to Y charts. So I basically limited the field of companies to those in the top 10%, the top 10 percentile, and then just basically went in and went after companies that have high projected annual returns and relatively high quality ratings, hopefully excellent amongst those companies, and then sorted them by one of our favorite technical analysis metrics, that relative strength index right down the middle. And just went through and circled some of the categories to show the lows or where we want them to be higher, just looking for which one is kind of popping off this chart. And the company that kind of is speaking to me is this ITRN location, the second one on this chart, with a return in the high teens, excellent quality, fairly decent relative strength index, but you can see an owner's return on capital of over 20%, decent expectations for the next year, and decent expectations when comparing the current price to the fair value, whether it's the Morningstar analysts or the analyst consensus. I do believe these guys are only covered by one analyst from Jefferies, but that's his consensus. So you can see some of the companies that we've actually talked about here fairly recently. Middleby is a good study right now. I think Lincoln National is a good study. If you're looking for a good bank to study, this is one that Ken has mentioned repeatedly, Greene County Bancorp, GCBC down the middle. But again, some fairly decent companies here to do some shopping style homework on, including one of our current multiple selections, Maximus. Another quick screen just to see if anything pops off the chart. I went in looking for companies with double-digit growth and a manifest rank in that ivory subcategory of being in the top 1.5 percentile. And lo and behold, ITRN location shows up here also. So I just finally had to say, I need to know what this company is about. Notice that Nick's 5 Below makes this list, as he was telling us that they've been punished price-wise. And a number of fairly recent additions, including Ken's Google from a month ago, is still on this list of stocks to potentially study. So let's talk a little bit about these guys. I'll start at the bottom line and work back. We are looking at a projected return in a kind of an elevated phase there, 20%, 21% or so. This is a small company, growing in the 14% range with fairly decent and consistent profitability. What do they do? These guys are basically in that field of what they call location-based services and wireless communication, predominantly in places like Israel, Brazil, Argentina, and the United States. But kind of the way you want to frame this, if you're talking about automotive stuff, you know, that where your car talks to the universe over the cloud, they're working with everybody you can probably think of, with the exception of Ford and Fiat. They're working with all the other companies, Volkswagen, GM, and basically coming up with these systems to make those exchanges of information powerful, including locating stolen cars, that sort of thing. But they're after, you know, stolen vehicle recovery and some tracking services to locate vehicles. Obviously, if you're in that business, very Garmin-like, very GPS-like, you can get into fleet management, which they do. So they're into fleet management services and logistics, that sort of stuff, real-time locator type services, and just working with a bunch of things, location of gas stations to car repair shops, the type of Yelp type stuff that we do on a regular basis. Interestingly, their subscriber base has grown continuously. We'll look at the visual analysis here in a second, and they do have a very high rate of retention. Once they get a customer, they keep them on the shelf, you know, with very little turnover, very little attrition. So gives you a little bit of background on the company. Again, one of our smaller companies. They didn't make our list this year. I'm not sure where they would have fallen off, but they did have a recent price drop, which probably brought them into range. Here's a look at that chronicle that Ken was talking about a few minutes ago. The thing I like here is the fact that the quality is marching up. So it's a little bit lower, but for a small company, that can sometimes be the condition, as their financial strength is a little bit weaker and getting stronger with time. But this company is improving with time. And you can see that the fairly recent price drop, the little slide that you see over the last 6 or 8 months, has now delivered because the fundamentals have been consistently strong. You are now looking at a mid-teens return forecast. Again, the highest levels we've seen in a few years. So again, this was not the time to buy it when it was here. But the fact that the stock price has relaxed a little bit and sagged, you know, maybe a little bit of January effect going on, not a bad situation. And again, with the right-hand side being near an all-time high, I find it fairly attractive. The visual analysis using the SSG, you can see it's not a straight line from left to right, but it's pretty close. I would call that pretty much up straight and parallel. And these guys are leveraged with some pretty decent car companies and insurance companies. And basically another one of those type of companies that's trying to put insurance to work, especially in the realm of logistics and that sort of thing. So I think it's worth digging in a little bit deeper. I'll probably come back to this one in the coming months, especially if the price stays down. And we'll go ahead and add an ITRN location to the tracking portfolio. So with that, Ken, I think we can go ahead and roll with a poll.
Okay, give me just a moment, Mark, and we'll launch the poll.
Trying to keep us fairly close to an hour and 15 minutes. I don't have a clock here, so I can't tell how well we're doing. And I don't want to touch my phone for reasons we talked about before the session.
It's about 9:45 Eastern time, Mark.
Okay, we're doing pretty good then. I'm trying not to touch anything that might drop me off. All right, looks like the poll is open. Are you still there, Ken?
Yep, I'm still here, and we have about 3/4 of our people voting. If you can just take a moment and record a vote, we'd appreciate it. It's nice to get around 90% voting. We're up to about 84%, so we just need a handful again here. I'm going to kind of count down in my head from 10, and then I'll close the poll. And let's close the poll. And let's share the results. So Kim's biotelemetry will add 2 positions in that, one for Kim and one for the audience then.
Excellent. Yeah, I would say from top to bottom, we're looking at some promising companies that have some growth to them. And that's always a real fine contribution to the portfolio.
Okay.
Good stuff.
I'm going to hide this poll and show what we're...
All right, where are we going to be, Ken? I guess the first one coming up, December 3rd. That's investing topics, and it's something that we've been talking about for some time. We're going to take the wraps off return on owner's capital and basically go through and tell you why we are interested in it. I'm going to probably spend a good portion of that hour with Ken in the role of Socrates, basically forcing me to defend my positions on some of these things. But the foundation for a lot of what you will hear that night comes from Joel Greenblatt. If you want to do some advanced work, we'll have some advanced stuff up on manifest investing. But look forward to having a fun time talking about that and a couple other year-end investing topics. Got a couple roundtables coming up. And Ken, why are we not doing one in December?
We're not doing one in December, Mark, because the last 2 Tuesdays happen to be Christmas Eve and New Year's Eve. So we're going to let people celebrate in a different way rather than coming to a stock presentation.
Now, come on, what could be more fun than sitting there with a adult beverage? And
we'll move our December roundtable to January 7th. We'll keep January's and the last Tuesday on the 28th. Mark has a makeup day in Sacramento, so if you're anywhere near the Sacramento area in late February, Leap Day, in fact.
Yeah, so we won't even know what year it is.
Right, take some time and go see Mark. The 2 of us are going to be in St. Louis. We haven't been in St. Louis in a long time, and this will be our first time ever being in Philadelphia in late April. And then I've been invited to visit Columbia, South Carolina in June. So it should be an interesting next 6 or 8 months. If you're nearby any of these presentations, if you can come and join us and say hello, that would be appreciated.
Yeah, and we'll probably have a few more additions here shortly. We're negotiating with some people now.
Don't forget about Bink too. I mean, you guys are going to be there in Dallas in the middle of May of 2020 also.
Absolutely. That should be on that chart by now. It's not on that chart.
And we have some wonderful invitations for August and September of this coming year. So we'll get those onto the chart when they come just a little bit closer. Mark said we're negotiating. We are going to be in Indianapolis. We just don't quite have a date set for Indianapolis yet.
There we go. I'll fill in the date later.
Okay. All right.
And I think all 4 of us are going to be actually teaching at that. So
it's the current thought.
Yep.
Mark, I have a pretty long series of questions. Can I try to cover a few of them here?
Let's see what we can do, and we can handle some in the after session too.
Okay. Nick, Rebecca would like to know, are there any concerns about the number or the amount of Chinese goods in the Five Below stores when you consider the all of the trade negotiations that are going on?
Right. Well, certainly right now it is having an impact with the tariffs that are in place. And I think if they can work things out and get things settled, that's going to only improve the situation for Five Below. I mean, again, some of that most recent downturn in their earnings and their pre-tax profit have come from the tariffs. So I look forward to them settling things and seeing a positive impact on Five Below. So hopefully that'll happen here in the next 6 months or something. I understand they're off to China soon with people that can make some decisions and may have a solution here pretty quickly.
Okay, we had a couple of different people want to know what CAGR is. That's compounded annual growth rate. That's an annualization of a total percentage growth. So if you say something grew by 200% over 4 years, then it can be annualized to a number which would be CAGR, compounded annual growth rate. Ross is suggesting, Mark, that as long as Hugh's not there, he'll vote for you. So Ross voted for your stock tonight, Mark, okay?
Well, thank you, Ross.
Okay.
All because I mentioned a couple of banks along the way.
Okay. John wants us to change the last choice to all of the above rather than none of the above. But I think we'll stick with none of the above. John, thank you, though, okay?
I like that.
I like that.
I do too.
Okay. Well, okay.
Well,
I'm in a decided minority here.
The bookkeeping might be a challenge, but okay.
Yeah. A couple of folks want to know the ticker talk about debt changes. That's going to be a week from Thanksgiving. So the date is December, and I'm just grabbing a calendar because I can't go to my computer. It is December 5th.
Yeah,
Right,
December 5th.
December 5th. And that's when Cliff will be talking about the changes to GAAP numbers, generally accepted accounting practices, that will go into effect for fiscal years that begin after December 15th, 2018. So the 2019 fiscal year for most companies is when that new regulation goes into effect. You can already see it being reflected if you look at your data on Better Investing site. Look at the monthly data. You can already see debt to capital ratios changing dramatically on companies that do a lot of leasing. And the two examples that we're going to use next Thursday are Ulta Beauty and Five Below, because they're classic examples of zero debt companies that lease almost all the space for almost all of their stores. They don't purchase real estate like some department stores might. We're getting a comment, Nick, from Jane in Western Michigan, and she says that Five Below has made it clear that they're exploring different supply chains, and they're not going to be tied directly to the Chinese supply chain forever.
I think it's true of a lot of companies that have been dealing with China. I've looked at some medical companies, medical supply companies lately that are doing the same thing, where they're moving some of their supply chains into what's going to be covered by USMCA, into like Mexico and some of the Eastern European areas. So yeah, absolutely. They're always looking for ways to get around that too, in addition to just waiting for the trade agreement to happen.
Okay, and Mark, that clears up the questions that we had, and I don't see any hands raised. So I'm going to give people about 10 more seconds here, and if I don't see anything, then I'm going to give a big thank you to Nick and a big thank you to Kim. As always, Mark, we couldn't do a lot of this stuff without your help and support. So have a happy Thanksgiving, everybody. And on behalf of the folks in mid-Michigan, I have a hand in the air. So hold on just a second, okay? Let's see if I can get that hand and figure out who that is. And the hand went down right as soon as we got it.
Just raising it to see if, have a happy Thanksgiving.
It worked.
Yeah,
okay.
absolutely.
So have a happy Thanksgiving, everybody, and we'll see you again the first week in January on the round table. Good night, everybody.
Happy Thanksgiving, everyone.
And in that case, Merry Christmas too. Take care.
Merry
Yes.
Christmas as
See you
well.
all next
Merry
year.
Christmas. Yep.
Bye.